Hi, you're welcome to Making It Count, Legal Accounting Made Easy with Benji. My name is Benjamin Ofeado, and on our previous episode, we looked at what accounting standards are, the need for them, who sets them, the legal basis for our use of them here in Ghana, and the various statements that go into the set of financial statements when it comes to the International Financial Reporting Standards. On this episode, we'll be looking at the principles or the concepts, the accounting principles and concepts for that matter, that underpin the preparation of these financial statements. There are a number of them, so we'll go through them one after the other. The first of them, the business entity. We would learn in company law that there is the concept of the separate legal entity. What this does is it separates the business and its operations from its ownership. So, similarly, when it comes to the preparation of financial statements, this principle is played out in there, where, for instance, a shareholder may provide a certain form of money to the business. That money will be recorded as an asset of the business, which is separate from the shareholder. All right. However, it will also be recorded as capital in the name or in favor of the shareholder. I hope you understand that. So we have separated the business as an entity from its owners, who are those who have provided capital for the setup and the operation of the business. So that is one of the key principles that underlie the preparation of financial statements. Good. The second is money measurement. When it comes to preparing and presenting financial statements, they are presented in monetary value terms. And so, for any asset or liability or equity or income or expense that is reported, it is reported in money terms, so that everything will be kept according to a single benchmark. And when it's being reported for a particular financial statement, there will be a single determined currency based on which the preparation of those financial statements will be done. And so if it is the Ghana cedi, then it will be the Ghana cedi used as the value measurement throughout the preparation of the financial statements. If it is the British pound, that will be it. If it's the US dollars, that is what it's going to be. So there is the principle or concept of money measurement. Good. The third principle or concept is the dual aspect of financial transactions. What does this mean? For every transaction, there are two legs to it. You would recall that I mentioned a shareholder providing money by way of capital for the setup of the business. And you recall that we mentioned that that transaction will, one, be recorded as an asset in the name of the company, but also will be recorded as capital to the shareholder. And so that transaction alone demonstrates both a debit and a credit. And so we'll be introducing the concept of debits and credits very soon, which is key when it comes to accounting and then the reporting of financial transactions. So don't forget this. To every transaction, I should say, there is a debit and there is a credit. Good. The fourth element is the concept of historical cost. There is a primary assumption of a certain stability to the value of any asset, liability, or capital. Any of those elements that you typically find on the face of the statement of financial position. What that means then is that transactions are recorded according to the cost at the time of transacting. And so, for instance, if a set of furniture was purchased, that furniture will be reported according to the cost of acquisition and bringing that furniture into use. So, transactions are recorded at the cost. Similarly, if, for instance, a loan was taken, the loan will be recorded at the value at which it was taken at the time the loan was granted. So there is the principle of historical cost. That said, however, for assets that tend to have an appreciable change in value by way of appreciation, there is the principle of revaluation. So although there is the primary concept of historical cost, also revaluation avails. So let's remember this. That's the principle or the concept of historical cost. Then there is the principle of separate determination. And what does this mean? Basically, what this principle or concept says is that for any set of assets and liabilities, they should be recorded separately as assets and liabilities without netting them off. So what this does for us is it gives us a full view of what our assets are and also what our liabilities are. Similarly, when it comes to transactions, let's record the incomes separately. Then we can also report the expenses separately. That gives us a sense of what our various endeavors would have brought to us by way of income and also would have costed us by way of expenses. And so remember very clearly, even when you look at the face of the statement of comprehensive income, you realize that we have incomes separately designated and then expenses separately designated. When you look at the statement of financial position, you see assets separately designated, liabilities separately designated, capital elements or equity elements separately designated. This is the principle that we just spoke about. Good. The next principle is the principle of substance over form. The full rendering of this principle, substance over form, is economic substance over legal form. Economic substance over legal form. What does this principle say? This principle says that for every transaction, we should prioritize the economic substance of the transaction over its legal form. Let me give an example. For instance, a company enters into a lease arrangement where it leases a building, and that building is leased, or the total life of that building is, let's say, 50 years. But then the company goes into a lease arrangement where it leases the building for about 45 years. And the building in its design and make is structured for the peculiar operations of that particular business. And what that tells you is that the building is designed and made primarily for the operations of this business. Although that building is not owned by this business, but it is owned by another party. What you do realize is that although ownership does not sit with the business that has gone into this lease arrangement, the economic substance of it is that the business will have control over the use of this building. And so there's this principle of economic substance over legal form, which says recognize that building as an asset, although the business does not have ownership of it. What that tells you is that we prioritize control over ownership in whether or not to recognize an asset or a liability. And so this is the principle of economic substance over legal form, which is simply said as substance over form. Then there is the concept of time interval. So per the International Financial Reporting Standards, primarily there is a concept known as the foreseeable future. And the foreseeable future is interpreted as the next 12 months. And this understanding has informed the time interval within which financial statements are supposed to be prepared. And so, the standard period for the reporting of financial information in financial statements is a successive 12-month period, or what you would call a year. However, for internal purposes, management may require that financial statements are prepared for management use purposes on much shorter interval, say on a quarterly basis, or 2 times a month, or 2 times a year, or even on a monthly basis. And now, with the enablement of financial reporting information systems, on a daily basis, financial statements can be prepared by companies. All right. So the time interval concept says that 12-month successive period becomes the standard reporting period for financial statements. And then there's this very important principle of materiality. The concept of materiality speaks to the fact that items or transactions should be reported separately based on the materiality of those transactions. And what does this mean? Is an item of significance enough to stand them out as an item to be reported? And so, for instance, when you look at your statement of financial position, under your assets, as we'll be finding out in due course, you may have fixed assets. And your fixed assets will be all your items that you use, like furniture, building, computer equipment, office equipment, all of those things that you use in the furtherance of generating economic benefit to your entity. So these are the fixed assets. They will be typically called property, plant, and equipment. All right. So these constitute a material set of assets. So it is important for you to disclose them as a standout on the face of your financial statement. And when you go to your notes, your explanatory notes, you can tell that even for the property, plant, and equipment, or the fixed assets that I mentioned, there are different elements of them which are material. For instance, motor vehicles. For instance, building. For instance, furniture and fittings. For instance, computing equipment, or even office equipment. Based on the materiality of these items, there is the requirement for you to provide disclosures to these further breakdowns in the notes to your financial statement. So the principle or concept of materiality speaks to the fact that for items that are considered material, we need to present separate disclosures for them. First, on the face of the financial statement, and also in the notes to the financial statement. There's also a certain principle known as the stability of currency. And this is the assumption that currencies will be stable. And so when transactions are reported, they are reported in the nominal values at which they were contracted. So if you bought a particular item for $500,000 US, there is the assumption of stability of currency. And so you convert it, if your reporting currency is Ghana cedis, you convert that US dollars 500,000 into the current date or the date of transactions US to Ghana cedi conversion rate and report the cedi equivalent, assuming that stability of currency exists between those two currencies. However, we know that currencies are not that stable. And so subsequently, when you are reporting, and let's say the payment of that value is yet to be done, that's 500,000, it's yet to be done. If you are reporting subsequently, you may now do a revaluation and then look at the changes as a result of foreign exchange transactions. But then the assumed position is that currencies are stable, and that is the stability of currency concept. Then there's the very important concept of going concern. You would recall that when we were talking earlier about the time interval, we spoke about the assumption of a 12-month period when we were defining the foreseeable future. This foreseeable future goes into this concept of going concern, which says that the company is expected to be in operation for the next 12 months or the foreseeable future. And so all financial statements as they are prepared with the assumption of the company being a going concern, which means that the company will still be in existence in the next 12 months. In a case where a company's financial statements are to be prepared and there is knowledge that the company will not be in existence in the next 12 months, it will be stated in the financial statements that the company is not expected to be a going concern, in which case the preparation of the financial statement will be on a certain basis we call the break-up basis. Just think of a breakup like a relationship. You don't expect to be together by the end of the 12th month. And so you prepare your financial transactions, the report of your financial transactions, on the basis that they're not going to be together. And so that will be called the breakup basis. However, if it is expected that the company is going to be in existence in the next 12 months, then the statements of the company will be prepared on a going concern basis. Then there's the introduction of the principle or concept of consistency. And you'd recall the principle of consistency when we were talking about accounting standards. You recall that, right? When a company adopts a certain set of accounting principles or accounting policies and estimates, there is the expectation that the company will apply those principles, policies, or estimates consistently so that it's going to help even for comparing their performance year on year or period after period. So the principle of consistency is very important, not only for comparing with other entities and also comparing against one's own performance, be it a subsequent period or a previous period. So the principle of consistency. And then there is the principle of prudence. Prudence. What prudence means in this context is that companies, in recognizing their earnings, are expected to be realistic about what those earnings are. And so there have been other renderings which will say that you would understate your earnings and then you overstate your expenses. That is not necessarily the case. What it is the case is that the prudence concept says recognize assets when you know that they are definitely recoverable. Recognize assets only when you know or there's evidence that they are recoverable. A typical example, when you have received a sales order or a purchase order, I should say, from a customer, and you are to deliver a certain number of goods to that customer, you do not go ahead to recognize revenue because you have received a purchase order from the customer. You only recognize revenue when you have delivered the items to the customer and you've generated an invoice for the customer. It is at this point that you recognize revenue. And what is important to be considered in this example is you recognize revenue only when you know that you have evidence or basis to recover monies from the customer. And what is that evidence or basis? You have delivered the boss. That's the prudence concept. Flip it to expenses. It is required that once you, as a business, you have placed an order for items and the items have been delivered to you, immediately as a business, you have a liability towards your supplier. And so at this point, the prudence concept says, don't wait for an invoice to be brought to you first before you recognize a liability. Once you have received the goods or the service, you have an obligation to your supplier. So you need to recognize your expense and also your liability. This is the concept of prudence. The very final concept we'll look at is the concept of accruals, which is somewhat connected to the concept of prudence. So the accrual concept says that don't wait for there to be a flow of cash before you report your financial transactions. Report your financial transactions once there is an obligation established between the parties. So record transactions once there is an obligation established between the parties. What do I mean by this? In our example used when we're talking about prudence, once you have delivered the goods ordered by the customer, you've delivered them, an obligation has been established within the relationship, where now the customer is obliged to pay for the goods. Similarly, in the case where the supplier has delivered goods to you, immediately an obligation has been established on your part to pay for the goods. So although there hasn't been payments made, the transactions need to be recorded. So you don't wait for payment being made before you record the transactions. And so record the transaction once an obligation has been established by virtue of the transaction. So you have either earned a revenue or incurred an expense. You've earned an income or incurred an expense. So accrual, once an expense has been incurred, not when it has been paid, record it. Still accrual, once an income has been earned, not when payment has been received, record it. That is the concept of accrual. So you'd realize that we've gone through 13 very important principles when it comes to the reporting of financial transactions in the various financial statements of businesses, organizations, or institutions, or even companies. This has been Making It Count, Legal Accounting Made Easy with Benji. My name is Benjamin Ofeado, and let's meet on the next one.